today we're diving into a very specific tool in a trader's arsenal, the gap reversal system. Now, you got to think of this not as your everyday hammer, but more like a specialized precision instrument. And the real secret to using it effectively is knowing exactly when and when not to pull it out of the toolkit. That's what we're going to break down right now. All right, let's get right to it. We've all seen them on our charts, right? Those empty spaces where the market just leaps up or down overnight. But how do you know if that gap is a trap or a golden opportunity? Well, the gap reversal system, or GRS for short, is designed to answer that exact question. So, what is this thing really? At its heart, the GRS is all about betting on a trend's resilience. It's looking for that very specific moment when the market gaps against a powerful ongoing trend. You can almost picture it like a rubber band being stretched way too far in the wrong direction, just getting ready to snap back. Now, before we get into any of the cool setups, there is one rule that is absolutely non-negotiable. I call it the golden rule of the GRS. It's the one thing you have to have, or you don't even think about the strategy. And there it is, simple as that. If you don't have a clear, obvious trend before the gap happens, the whole system just falls apart. This is the bedrock, the foundation of the entire idea. No trend, no trade. Seriously, it's that important. So what does a clear trend actually look like on a chart? Let's break down the two main flavors. For a bullish setup, where you're looking to go long, you need a textbook uptrend, higher highs, higher lows. You'll see the price kind of riding along that upper Bollinger Band and staying comfortably above a fast-moving average, like the 90 MA. For a bearish setup, you just flip it. You're looking for a clear downtrend, lower highs and lows, with the price hugging that lower Bollinger Band. These are the telltale signs you're hunting for. And what if the market's just messy, bouncing around, going sideways with no real direction? The answer here is super easy. You don't use it. The GRS is not for choppy markets. A gap in a sideways market is just random noise, not a high probability setup. So just keep that tool in the box. Okay, so we've confirmed there's a strong trend. Awesome. Now we have to check the environment. Think of it like a pilot checking the weather before takeoff. We're looking for the perfect conditions for the GRS to really work its magic. And here's what that perfect weather looks like. Imagine some overnight news hits, and it causes the market to gap against that beautiful trend we found. There's enough volatility in the air that the Bollinger Bands are getting wider. And here's the kicker. The gap is big enough to blow right through a bunch of obvious stop-loss levels, which stretches the price all the way to the opposite Bollinger Band in one clean move. When you see all that line up, that's the setup. Now, this is a really important distinction. We're not necessarily looking for some kind of massive, once-in-a-decade gap here. The word we're focused on is significant. But what does significant actually mean when you're staring at your screen? Okay, so a gap becomes significant in two ways. First, it just looks big compared to the recent candles on your chart, say a 30-minute chart. But way more important is that it causes the price to slam into or even punch through the opposite Bollinger Band. That's the key visual confirmation you're looking for. It's a sign of a massive, but likely temporary, overreaction. Perfect. We know the trend we need, and we know the weather conditions we want. But where do we go looking for these setups? This strategy doesn't work everywhere. You've got to be picky and choose the right playground. The GRS really loves markets with tons of liquidity and lots of big institutional players. So you want to focus on major indices like the S&P 500 or highly traded futures. On the flip side, you absolutely want to avoid things like illiquid stocks, penny stocks, or markets that just don't move much. They don't have the clean price action and volume needed for this to work reliably. And if you are going to trade individual stocks, you really need to stick with the big guys. Large cap stocks that the big funds and institutions trade all day long. Why? Well, because they tend to have much cleaner charts, cleaner gaps, and that healthy intraday volatility this system thrives on. All right, so we've got the trend, the weather, and the playground. There's one last crucial piece to this puzzle: timing. As it turns out, the time of day is just as important as anything else on the chart. So what's the magic time? It's right at the start of the day. The absolute golden window for the gap reversal system is the first 1 to 2 hours after the market opens. That's when this strategy is at its most powerful. And why is that? It's actually pretty logical. The gaps we're hunting are a result of all the news and sentiment that built up overnight. So when that opening bell rings, you get this huge rush of early institutional money reacting to that news. And that's what creates the powerful reversal move we want to catch. The whole system is built for that opening flurry of activity. Now, you might be wondering, can you find a GRS setup in the middle of the afternoon? Yeah, sure, sometimes a big news story will break and cause a similar pattern, but honestly, those are the exception, not the rule. Your bread and butter, your main focus should always be that morning session. Okay, we've spent a lot of time talking about when to hit the gas, but knowing when to hit the brakes is just as critical. So let's run through a quick pre-trade safety check. Think of it as your final go/no-go decision. Before you even dream of placing an order, just do this quick mental run through. 1. Is the gap clean? 2. Was the prior day's trend really a trend, or was it kind of choppy? 3. Is there any huge market-moving news scheduled for later in the day? And 4. How's the volume look? This whole check takes like 30 seconds, and it can save you from a world of pain. So, what are the big red flags? When do you just walk away? Well, if the day before was messy, showing signs of big players either selling off or buying up positions instead of a clean trend, just skip it. If there's a huge event like a Fed announcement later in the day, that can throw everything off. And if the volume is super light, maybe because of a holiday, the moves just aren't trustworthy. If you see any of these, it's a no-go. And honestly, this might be the most important takeaway of the whole thing. The true mark of a pro isn't just knowing a good setup when they see one. It's having the discipline to sit on their hands and do nothing when the conditions aren't perfect. Forcing a trade with a specialist tool like the GRS is a recipe for disaster. So let's recap the whole toolkit real quick. Rule number 1, the golden rule. A clear pre-existing trend is an absolute must. Then you're hunting for significant gaps, and you're doing it in high-volume, liquid markets. Your focus is locked in on those first 1 to 2 hours of the day, and you always run that final pre-trade safety check. We've covered the what, the when, and the where. You now have the complete checklist for spotting a high-probability gap reversal setup. So I guess the only question left is this. Now that you know exactly what to look for, what market will you be watching at tomorrow's open?